All right, guys, here's the deal. I went through countless articles, stock lists, analyst opinions to find out what people are calling the most undervalued stocks in the market right now. And three names kept popping up over and over. From NerdWallet to Yahoo Finance to newsletter headlines. These stocks are getting attention. But here's the thing. I don't trust the headlines. You should not trust the headlines. I trust the numbers and the story that's real. So in this video, we're going to break each stock down through the lens of value investing to see if they actually make sense. No hype, no speculation, just a clear look at price versus value. Let's get into it. Our first stock is Uber, and let's talk about why some analysts think it's undervalued. I've been reading through these analyst notes and these research write-ups, and even some shareholder letters from big investors like Bill Ackman's Pershing Square Fund, who made a $2.3 billion investment earlier this year into Uber. And here's the interesting part. They're calling Uber one of the most undervalued opportunities in the market right now. Now, that doesn't mean you should go out and run and buy it. That's not what we do here. But it does mean that it's worth understanding why they think that and what we can learn from it. Here's what they're saying. First off, Uber has a dominant position in both rideshare and delivery. True. They're winning in both lanes and growing their share tremendously. Analysts point out that Uber has become a platform, not just a taxi app. But the real shift has been into profitability. Ackman mentioned this in his earlier shareholder letter that Uber is finally generating real cash flow. If you remember years ago, the CEO of Uber said, the market has changed. It's about cash flow now, so we're going to focus on cash flow. They're improving their margins, especially in the delivery business, and they're turning that cash into value. And they're buying back shares, which rewards long-term shareholders as long as they buy them back at the right price. Pershing Square also emphasized Uber's diversified revenue streams, things like advertising, subscription services like Uber One, and the steady growth of their freight and logistics divisions. And unlike other capital-heavy businesses, Uber's model is asset light. What that means is they don't have to invest money into factories and into fleets. Drivers use their own cars. That means Uber can scale without spending a fortune. That's really important and a huge advantage for companies like Uber. So why is it considered undervalued? Well, according to Ackman and other people, the market is still stuck on old fears, things like autonomous vehicles or worries about regulation. But they argue that while those are long-term considerations, they're not affecting the actual cash flow right now, and that's key. Ackman wrote that Uber is producing strong excess cash flow, and he expects, you ready for this one? He expects earnings per share growth of 30% or more over the next few years. What can you take away from this? Well, it's quite simple. You don't have to agree with Bill Ackman. We all don't agree with Bill Ackman at times, and he won't agree with me at times. But when you see smart investors digging in the numbers instead of chasing hype, it should make you stop and take a look. Uber may not be flashy anymore, but that's kind of the point. Real investors are starting to pay attention because the story is turning into free cash flow, and free cash flow is what matters. When it first started, it's this exciting, revved up engine, getting ready to explode. This is the next big thing, and it was. But at some point, people are going to overpay for that. And according to Pershing Square and some Wall Street analysts, Uber's value is a lot higher than its current price. Now it's our job to decide if that makes sense. Not based on emotion, based on logic. That's how we think like investors. That's how we use a principle-driven approach to investing. So let's take a look at these numbers on Uber. Let's pull it up in our software. Okay, so it's a $195 billion business. It's crazy to think that a $195 billion market cap business is even a small business, but it really is these days. They have a $220 billion enterprise value. This $25 billion difference is essentially their net debt. And here's what's exciting. Last year, they generated $8.5 billion in cash flow. That's incredible, guys. That means they can pay off that net debt in about 3 years. Here's what else is good. Their 5-year average net income is $635 million. Their 5-year average free cash flow is 2.63, 4 times higher. But last year's net income was $12.6 billion versus $8.5 billion free cash flow. So there's going to be some playing catch up here on the free cash flow front. It is selling for 23 times free cash flow, 15.5 times earnings. Okay. Now, the return on invested capital is still low at 4.8%. but it was negative for the last 5 years. This is very common amongst growing businesses that are investing a lot of money into not generating cash flow. Our return on invested capital is based on cash flow. So when it's not there, it's causing a problem. And that's why you see such a big difference in those numbers, 5-year and 1-year return on capital. 40% gross margin. This means every single time you use Uber to take a ride or to order something or deliver something, 40% of that is going into Uber's pocket before overhead. And look at this. The 5-year profit margin was 2%. 1 year, 27%. They clearly cared about profit after a while. So a lot of great stuff happening with Uber. Let's go look. Oh, and by the way, our current community has this as a buy rating with an intrinsic value average of $130 per share. Now, it's just a way of referencing it. The company's currently at $92 a share. We'll get into that very shortly. Let's go to our 8 pillars here. Okay, 5 X's, 3 checks. Isn't that interesting? What are the checks? Revenue growth, net income growth, and cash flow growth over the last 5 years. Very simple. Everything else is an X. I'm not worried about debt because their free cash flow is so much higher. This debt is based on the 5-year free cash flow, but their 1-year free cash flow is 3.5 times greater. The PE and the price of free cash flow, not worried about it. Why? Because their earnings and their free cash flow are so much greater in the last year than the last 5 years and getting better. So I'm not worried about these 8 pillars. It's just telling me like, hey, this story it's a growth story and it's still growing. They've turned things around to become a cash money making machine. Now, guys, if this feels overwhelming, trust me, you're not alone. Everybody in the world of investing at some point has been overwhelmed. The question you have to ask yourself is, do you want to get through it? Do you want to get better? I'm going to be here to try to simplify this as much as possible. One way I'm going to simplify it, all these key metrics, I have for free in an easy to download PDF. It's easy for you to get it. It'll explain all of these metrics, what they mean, why they're useful. That way we're all speaking the same language. I'm not here to overwhelm you. I'm not here to try to sound smarter. I'm here to help lift you up to speak the same language that you can get to a better place. This is exactly why I teach on YouTube. I got so frustrated with everybody trying to sound like they're smarter than they actually are. I want to be here to explain it as simply as possible. Like it's a local lemonade stand. Like it's your neighbor's mechanic shop. How are you looking at this? If you looked at Uber right now like it was your neighbor's mechanic shop or your neighborhood lemonade stand, you'd say, oh, wow, your profit is up a lot in the last 5 years. You must be doing a lot better. Why are you doing better? Well, we focused on cash. Great. What did you do to do that? Things like that you would ask. In just a few minutes, we're going to figure out the right price to pay for the stock based on my assumptions. But let's take a look at analyst estimates right now. Earnings per share. So what's interesting, guys, is it's only a 50% increase in EPS over the next 4 years, from $3 to $4.60. Not as much as you would have thought. 50% increase? Okay, Ackman's thinking about 30% for a few years. Analysts do not agree here. Yeah, getting there, but a big drop in year 4. But revenue? Look at this. 17, 15, 14, 11, 9% revenue growth for the next 5 years. As you can tell, as time goes on, it's slowing. That's the big key here. Now, we have somewhat of a story. We have some numbers. The first step that you must take before you fall in love with a business is go to our stock analyzer tool and figure out the price that you would find appropriate for this company. Why am I doing it so quickly? Well, guys, it's useless to go do all this research on a company if it's not even selling anywhere close to a reasonable number. I always use a stock analyzer tool within minutes of looking at a company. Why? I want to make reasonable assumptions and say, hey, this company's selling at 92. If stock analyzer tool tells me it's worth 10, why would I spend any more time on it? But if stock analyzer tool says it's worth 100, I'm going to spend some time on it because it's lower than that price. That's the key here. So let's pull up the last time I did Uber. Okay, I did a 10-year analysis. You can do anywhere between 1 and 20 years. I did 5, 8, and 11% revenue growth. Probably low. Probably low. Maybe we go with 6, 9, and 14. Seems reasonable for a 10-year number. Okay, what about profit margin? Now, here's where it's tricky. They just did 18% in free cash flow and 27% in profit. So it shows they can make a lot of money. Is this a fluke? I don't know. At 40% gross margin, 26.7% seemed high. I did 12, 18, and 24. Maybe we go a little bit higher. Maybe we go 15, 25. No, let's go 18, 24, and 30. Guys, this is what makes investing hard, especially in businesses that are newly profitable. We don't know if this is a fluke year or not. Could it be? I don't know. Actually, you know what? I don't feel comfortable with that. I'm going to go 18, 22, and 26. And guys, that might be too conservative because the high number is equal to the current one-year number. So I might be too conservative here. That's something to factor in. Next question. What's the PE that you would apply to a company 10 years down the road that fit these parameters? Well, guys, what I always tell people is start at the market average of 15 or 16. Go higher for good companies, go lower for bad companies. What makes a good company? Companies where ROIC is good. Here it's not good, but it's getting better. It has growth potential and has some sort of moat. I think in the world of these taxi services, Uber is the leader. Yes, Waymo's coming up with Google and it's driverless, but Uber's working on its driverless as well. And finally, my desired return. Guys, I put 9%, 9 or 10% to get my intrinsic value. I'm not sitting there I'm not sitting there trying to get what's the price I would pay because I'm not interested in 9 or 10%. To buy an individual company, I need a higher return than a long-term ETF. So for margin of safety, you'll want to put a higher number in here. But I don't know what your higher number is. If you know a lot about Uber, it should be lower than somebody who doesn't know much about Uber. That's the key here. That's the art of investing. So now, guys, I hit the analyze button. The stock's currently at $92 a share. Now, guys, this is where it's interesting. A low price of 86, a high price of 301, middle price of 150. Now I see what Bill Ackman is saying. This is a 15.75% return if my middle assumptions up here occur. Will they? We don't know. But if I have 30 or 40 stocks that my middle assumptions are getting me 16% returns, I'm probably going to do pretty well. That's the key here. Now, 15% returns are exciting, but most investors lose money because they're trying to pick the 15,000% returns, the huge winners. Guys, the best investors do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a stock. Now, guys, our titles here, we do a lot of titles because the business of YouTube is we want to get you to click, but I'm here to teach a process. I'm here to teach a way of you learning how to fish. It's not for giving you say, hey, go buy this, go buy this, go buy this. No, it's about sitting there, understanding how you look at things, how you use a stock analyzer tool to weed things out. Guys, to me, what this says here is do some more research on Uber for myself because there could be potential there. Stock number 2, Pinterest. Guys, why are analysts now saying Pinterest might be undervalued? Well, let's walk through it. First off, Pinterest is different from other social media platforms. It's not about posting selfies or keeping up with friends. People go on Pinterest with a purpose. They're looking for ideas, recipes, home projects, fashion, gifts, and guess what? That kind of behavior has amazing commercial intent. When my wife and I were recently renovating our house, 3 years ago when we first bought the house before we renovated it, I literally went to Pinterest and said, I like these. She looked at my ideas and said, okay, I like these ideas too. Or some of them she's like, yeah, I don't like that idea so much. But that's how we handled it. In simple terms, users on Pinterest are already planning to buy something, and advertisers love that. That makes Pinterest ad space more valuable than on platforms where people are just scrolling to kill time. So think about it this way. When you're scrolling on Facebook and Instagram, you're not thinking, how do I find an ad to buy? How do I find something to buy? You have to get interrupted and say, oh, that looks cool. I might buy that. With Pinterest, people are going there because they want ideas on things to get. Next, analysts are excited about Pinterest's future potential with AI and shopping integration. Let's talk about big tech companies scraping Pinterest content to feed their AI models. And eventually, those scrapers will have to pay. Now, CNBC's Jim Cramer even said that Pinterest is one of the most undervalued social platforms along with Reddit. I will say, if Jim Cramer's saying that, it's kind of a point of me being concerned. But his point is that Pinterest is filled with content that helps people learn and shop. And that data could be very valuable in the AI arms race. Then there's the shopping angle. Pinterest is quietly turning itself into a personalized shopping platform. That means users can go from inspiration to purchase all in one place. Oh, you like the way this room looks? All these items here are for sale. Click on them and buy them. This opens the door to more performance marketing, which is basically advertisers paying directly for measurable results like actual sales. And let's not forget, Pinterest has made it through some tough storms. They handled the pandemic, they adapted to Apple's privacy changes, and they're still standing. That shows resilience, and it shows management knows how to navigate rough waters. But we must look at the numbers now. Pinterest PE ratio. Guys, look at this thing. 11.84. That's what's incredible. 11.84. That is way lower than all of the social media companies. Some analysts even use a metric called the FAIR ratio, which suggests that Pinterest is trading below what its fundamentals are worth. And here's something unique to Pinterest. Their content doesn't expire overnight. A pin on Pinterest can keep driving traffic for months or even years. That gives the company a long tail of value that platforms like Instagram and TikTok just do not have. Pinterest isn't a hype story. It's quiet, it's not flashy, but the business model is strong, and it goes after users who are real that have long-term real ad revenue value. And that long-term content that continues to work. The stock has fallen a lot in the last 3 months. How much, you might ask? 13.5%. Not because, and as value investors, that's when we pay attention. Not because it's a guarantee to bounce back, or we think that it's now cheap because it's down 14%. But you sit there and look and go, why would people just drop it that much that fast? This is where you have to use your brain and ask that question, not your emotions. So, is Pinterest a buy? Well, that's for you to decide after doing the work. Price is what you pay, value is what you get. Let's go see if my assumptions make the price relative to value much bigger gap than most places we can find. So let's look at some metrics on Pinterest. The best one, market cap of $22.8 billion, buying all the shares. Guys, look at this enterprise value, 20.74. That's a $2 billion net difference in debt. They have more cash on hand than debt. And they still generated $1 billion last year in free cash flow. Now, that billion is less than 1.93 billion they generated net income. And whenever we have free cash flow over the net income, you got to ask the question, why? I'm not going to get into that here, but it is a question to ask. Now, our users have Pinterest as a buy with an average intrinsic value of $30 a share. It's currently selling for $33. Okay. Now, I look at this and go, profit margin of 50%. The 5-year profit margin of 14.5%. Their gross margin is 80%. Think about how much different. They double the gross margin of Uber and double the profit of Uber. 50%. This is like Visa type numbers here. This is incredible, guys. Big time numbers, big time money. Again, no returns on capital because growing business. Let's check out the 8 pillars here. 5 checks, 3 X's. 2 of the 3 X's are 5-year valuation metrics, which we've basically thrown out the door because of the recent growth and its profit. And of course, the return on capital. So overall, guys, I don't really worry about this 8 pillars even here. Let's see what the analysts think. Analysts think that earnings per share will go from $1.84 this year to $3 in a few years. That's not much growth, 55, 60%. A decline in 2029, no idea why. Even though they have revenue growing, ready? 17, 15, 14, 12, 9%. From 4.3 billion to 6.9. I don't understand that. How can revenue grow, according to these analysts, by 10+% a year and then profit is only up, I don't get that. But either way, it's something to consider. So of course, where does that put us? It puts us in the territory of how do we value this business? So this is when I did Pinterest a long time ago. Let's look at revenue growth. Let's do 6, let's do 7, 10, and 13%. Profit margin. Let's do 20. Now, let's do 25. Oh, man. See, this is the thing. This is what makes it hard, guys. Look at our 5-year average of 14.5%. Then they started caring about profit, and now they're at 50%. Is it 50% really? Or is it something else? Their free cash flow is only 27%. You know what I'm going to do? I'm going to go to their financials and see if there was something fluke that happened in the last year. So what I'm trying to look for is a one-time income. No, nothing. They just made a F-ton more money. That's it. They just made an F-ton more money. All right. So I'm going to do 40, 50, 42.5, 50, and I'm just going to do 55. And guys, even though free cash flow is lower right now, it'll probably equate out over long periods of time. So I'm going to do that. Now, PE and price to free cash flow. Again, you start at 15 or 16. Guys, I like this 14. I'm going to do 14, 18, and 22. Because over time, if they're able to do these numbers, it's going to justify a higher premium for the company, not the 15 or 16. But if they don't, 14's fine. I don't know. This is very, very difficult. I want you to realize how difficult this is. Like, even I'm looking at this going, how do I value this thing? And then finally, my desired annual return. Now, before there, I had 15%. Guys, I think this is a company that needs a lot of margin of safety because such big fluctuations in profit. But again, if you do your research and realize that this company is probably on its way to a very successful future where this is just the norm, then you can probably make a much more consistent guess. But the stock's currently at $33 a share. I hit the analyze button. This is why it's interesting. I have a low price of 48, high price of 132, middle price of 82. Middle assumptions occur, it's 22.5% return. Low assumptions occur, it's still 14.5% return. If a genie came down and said, Paul, you're going to be right on all of these, it's a buy today. That's the question. Is that going to happen? And I had my profit at 42.5%, not 49. That's why people are interested in this company. That's why this company is considered undervalued by a lot of places. Now, guys, believe it or not, 25 years ago, I probably would have bought Pinterest at a much higher price because I would have bought into the hype of the story. I would have said this thing is changing things just like NVIDIA and Palantir, and I would have never run the numbers. I was chasing those hot stocks and following those tips. Guys, I learned very quickly and very expensively that that's not investing, that's gambling. And that's exactly why I created this channel. That's exactly why I created the software. I wanted to give myself and 20-year-old Paul the tools, the strategy, and the community that I never had that I needed. It's really important to surround yourself. We do a foundations course where we talk to everybody about the stock analyzer tool. And I say, you've got to have conversations with people about what are the right assumptions to put in. This would have been a great company to talk about. Why? Because somebody would have probably done the research and said, Paul, this is a fluke. Or Paul, this is the real deal. That's why it's important. So when you join Everything Money, you're not just getting the powerful investing software in our famous stock analyzer tool. You're getting a foundation. We integrate you into the community by watching courses that are absolutely free of charge, so that we all have the same foundation. And we get you engaged into our community of like-minded investors who have one goal: to level up their investing so that they can make more money and sleep better at night with the right mindset and support, along with the right software and tool. Guys, this isn't for everyone. It's just for the right ones. So if you're committed to investing the right way, if you're committed to learning how to fish, start your 7-day trial today. Click the link below. We have limited spots. And guys, I'm absolutely serious. If you're not trying to learn, we are not the place for you. If you're trying to get hints, just tips, you're going to be ousted out of the community. I guarantee that. But if you're trying to learn and level up your investing, I will see you in the community. Now, our final stock, Comcast. The stock is actually near a 52-week low, and you know how I feel about that. It's a great place to look for value. Not because it means something's automatically cheap, because if it's already down so much, there's probably a reason for it. The question is, was the market overly dramatic about that? Now, here's what analysts are saying. Guys like Ken Fisher and Benchmark are calling Comcast undervalued. Fisher's own firm owns millions of shares, and Benchmark has a $48 price target, which is a decent jump from today's $29. But why do they think there's value here? Let's break it down. Comcast is a global media and tech company. They own Xfinity, NBC Universal, Peacock, and even theme parks like Epic Universe. So they're not just a cable company. They got fingers in broadband, streaming, and entertainment. But the stock is still beaten up. Why is that? Well, because they're losing traditional cable subscribers. Cord cutting is real. People are switching to streaming, and that's hurting the old business model. Guys, I've got 5 Airbnbs. Nothing makes me happier than not having to sign up for cable. I just go to every house and get a new Netflix account, a new Hulu account, a new Peacock account, sign up for all of them. All my guests will have that forever. It's so much easier than, hey, how's it going? It's terrible. On top of that, they are facing competition in broadband from fiber and 5G providers. But let's be honest, media is a tough space right now. But here's where the value argument gets in. Because remember, guys, just because a business might even be declining doesn't mean it has zero value. With all of that going on, Comcast is still producing huge free cash flow. Analysts are pointing to an 18% cash flow yield, which is pretty massive. That's like saying for every $100 in stock, they're generating $18 in excess cash flow. They're also spinning off weaker units and focusing on high growth areas like broadband improvements and theme park expansion. Yes, guys, I said that right. Theme parks. Their Epic Universe Park and a new Las Vegas attraction are expected to boost the content and experiences side of the business. It sounds a lot like the show Succession with their parks and their content and their cable and all that stuff. And let's not forget, they pay a very consistent dividend, which is attractive for investors, right now yielding 4.3%. And one more thing, their valuation metrics are dirt cheap. They've got a low PE ratio of 5. And some models even say it's trading below intrinsic value, which means you might be getting more than you're paying for if you believe in the turnaround. So here's what I want you to take away from this. Comcast isn't perfect. They have a lot of debt, which is always scary. That's why the stock is cheap. Is this like Walgreens and like AT&T with lots of debt? I don't know. Everyone already knows the bad news, though. The question is whether the market is underestimating the value of what they still own and what they're building next. I'm not saying Comcast is a buy or a sell. I'm saying this is where you dig in because a 5 PE and a 6.5 price of free cash flow is very attractive. The price is down, the emotions are high, and that's when smart, clear investors start to think. So let's dive into the numbers. Guys, 5-year profit margin is 12%, last year 18.5%. Got to know if that's here to stay or not. Big time dividend of 4.4%, which is way lower than its $16.6 billion it generated last year. Keep in mind, that $16 billion it generated is well below the $23 billion that it did in net income, but the 5-year free cash flow is very close to their 5-year net income. So I'm not worried about the 1 year. Now, here's the scary part. $110 billion market cap, $276 billion enterprise value. That's $167 billion in debt relative to 16. It's basically 10 times the cash flow. That's a concern. That is a concern. That's what AT&T has going. That's a problem here. And that is exactly probably why their return on capital is so low. This is when I had Walgreens and I sold it, ironically, at a profit, even though I realized I was wrong just because the market went up. This is what my issue with Walgreens was. Low returns on capital, lots of debt. And I was like, okay, maybe there's something else there. I don't know. Let's look at the 8 pillars here. All right, the debt level is bad, like I told you, and low return on capital. Everything else is a check, and they're buying back lots of shares, which I love. I'd also be paying down debt, guys. I'd cancel this dividend, pay down debt, buy back shares in combination. In 10 years, you'll owe a lot less money, and you'll have a lot higher earnings per share. Seems to make sense to me. But you have to understand where their business is going. What do analysts think? Oh, wow. Look at this profit growth, 2.5%, 5%, 5.5%, 5 point. I mean, this is nothing. This is nothing. But you don't need to be a grower. You just need to be a shower. It's the other way around. Don't be a shower, be a grower. I don't remember. Look at this revenue growth, $127 billion to $133 billion. Wah, wah. Guys, this is a declining business. So this stock analyzer tool, I really want you to check out here because I think I'm going to be pretty excited to do this. So here's what we're doing with stock analyzer tool, especially for a company like this. This is going to be very different than the other two companies. This is let's do the not good way of going. Let's go this way. -2, 0, and 2% revenue growth. Haven't seen one of those in a while, have we, guys? Profit margin. I'm going to focus on free cash flow here. So I'm going to look at the free cash flow number here and mimic this, essentially. I'm going to go with 10.5, 11.5, 12.5. Okay. Now, PE. You start at 15 or 16, you go up for good companies, down for bad companies. I consider this a bad company. Lots of debt, low returns on capital, no growth. I'm going to go crazy. I'm going to go 9, 12, and 15. Actually, nope. 8, 10, and 12. This is a declining business. This thing sucks. You got to buy this because there's just so much, it's being beaten up so much that it makes sense to do so. And my 9% desired return. This is my intrinsic value. Now, remember, everybody in the community said the average was $45. I hit the Analyze button. Wow. I have a low price of 28, high price of 53, middle price of 40. And guys, guess what? Remember one thing. I want to repeat this over and over. These returns down below include the dividend. So, is it worth taking a look at? Yeah, probably. Taking a look at it. So I do see why all these people had these as value plays. Now, earlier this year, guys, I picked 7 stocks that are value plays, but have a bright future ahead of them. I made them my own Magnificent 7 to go against the real market's Magnificent 7. I want you to watch this video to see which stocks I own that are part of my Mag 7 and how they stack up. I'm going to be watching this for years to come, and guess what? The results this year have surprised me immensely, and they'll probably surprise you. Thank you for your time.